Good morning, everyone. Thank you for attending our financial awareness webinar this morning. My name is Tony Gardiner. I'm part of the advisor team at Beaufort Financial in Reading. We're very pleased to be joined today by Kate Palmer and Susie Dingley from Rathbones Investment Management, whose presentation will take us through some of the financial facts and thoughts around the industry, and I'm sure you'll find benefit from them. Following from that, I will give a short overview of our life plan cash flow tool, which I hope will show you the benefits of not delaying your saving plans. We'll see from the use of this software as a fundamental backbone of our financial planning service and something we use for all our clients to help keep our focus on the retirement goals and life aspirations over the years. If you do have any questions, if you'd mind just dropping them into the chat box at the bottom of your screen, and we'll get to those at the end of the presentation. If for any reason we run out of time, which sometimes happens, we'll get back to you via email and answer any of those questions for you. So on that note, if I can pass over to Kate and Susie to take us through their presentation. Thank you.
Tony, and good morning to everybody. Thank you for joining us on what's a quite miserable Wednesday morning. Right, I'm just going to share my screen and bring up what I hope is going to be a presentation. Sorry, just one moment. Oh, let's hope this works. There we go. So these slides are taken from our Your Money, Your Future financial awareness programme. And this morning we're just going to take you through a few of the sort of chapters from that programme. So as Tony very kindly introduced us, you've got me, Kate Palmer, and my colleague Susie Dingley. So the chapters that we're going to focus on today are financing your life, investments, risk versus reward, and then hopefully we can try and bring that to life a little bit for you by talking about some different asset classes, things that you can invest into. Financing your life. I'm sure that many of you are, different stages of your life, but if we take a step back and think about when you first perhaps entered the workforce or when you finished university, I don't think it's something that any of us sort of sit down and plan. We just sort of get on with life. But if you take a step back and think about your financial aspirations, what are they? You want to potentially buy a family home. Do you want to have children? Obviously you're going to need to pay for their upbringing no matter what, but do you want to also pay for a private education for them? And then there's financing your retirement. If you're going to retire at 65, potentially live to 100, that's another 35 years that you're going to have to pay for. This slide is very simplistic, but it just gives you that idea that throughout your life, you've got your general expenditure going along the bottom. You're going to be paying off your house. You're paying for your mortgage, which is the sort of purple section there. And then there's education potentially for your children. And even if they don't have a private education, will they go to university? Will you help them with those costs? But what you can see from the orange is that throughout your working life, you're paying off the mortgage, but you're also hopefully saving into whether it's a pension or just other saving pots. And then hopefully, I say hopefully because I don't think it necessarily happens too much these days, but hopefully around your mid-50s, the children have flown the nest and you can save more into your pension, your savings before you then retire. So how many children might you want? How much does it cost to raise them? I find this quite staggering, so I always like to point this out to children if we do any courses like this in local schools, to make them well aware that they are expensive and it costs, 150,000 approximately for a couple to raise a child to 18. If you're going to educate them privately, there's more costs on top of that. and obviously if you want to send them to boarding school, it's more expensive again. Your home, I think we're all probably well aware of this. Location, location, location. The cost of it is going to depend on where it is and obviously how big it is, how many bedrooms, or in this current COVID world, potentially how many offices do you need, and how much garden space. And then what is probably key for everybody is this idea of saving for retirement. So throughout your working life, your salary comes in, you have your ongoing day-to-day expenditure, but what I hope that everybody is doing is that you have this sort of this drip, drip, tap, you know, going into your savings. So month by month, even if it's a small amount, you've got bit by bit going into the savings pot. And then what happens at retirement? Salary stops, and that savings pot becomes either your income or you're drawing down on the capital of it, but that's going to meet your day-to-day costs going forward throughout your retirement. So let's look at an example. This is an example, say you're retiring today, a couple, how much is it going to cost? You know, what are your annual outgoings going to be? We're going to again keep it simple, and we're just going to ignore inflation. But just to give you an idea as to what that figure is, what do I need, what income do I need to generate, or what capital am I going to need each year throughout my retirement? And obviously everybody's going to be completely different when it comes to this, but I think it's quite a useful exercise to work out what it is that we're going to need. And in this example, it's for a couple, they're going to need £45,000 a year. So again, we are keeping things simple because we're ignoring inflation, and we're saying that actually we can, we think that over our retirement life, or, you know, over the part of our life that we're retired, we're going to be able to generate a 6% return from our savings or our pension, whatever it may be. And we're just going to use that then, that 6%, to work out what size of a pot we would need at retirement. So if you want to generate the £45,000 worth of income a year, and you're getting a 6% return, you can do that from a pot, savings pot, that's £750,000. So assuming we need that pot for our retirement, we have a house that costs about £600,000, and we're going to pay for children's education. Then you can see that the total capital needed is over £2 million. So yeah, if I made everybody even more gloomy than they perhaps already were looking out the window this morning, don't panic. The race is very long, 40 to 50 years long. Again, this is assuming you're straight out of university until you retire. It's all possible. So investment markets can help you to reach this goal. Let's say we need to save £2 million. So what can you do with your savings? On an ongoing basis, you need to save £2 million. What are your options? You can stick it under the mattress. You can put it on bank deposit, or you can invest it. What's the problem with sticking it under the mattress? You have no growth, no potential for growth, and you're going to be hit by inflation. I also like to point out there's a security slight issue if we're putting it under the mattress, but yes, you don't have any chance of any capital growth, and you're going to be hit by inflation over time. So if we focus on inflation for a moment, because I think inflation is something that we all need to be aware of. It's been quite low for a period of time, but it's something that's always there in the background. And this chart shows you that it's always there in the background. There are times when it goes higher, times when it comes back down again. For those of you who you know, potentially had a house in the 70s, may be well aware of how high inflation was and how high the interest rates were at that time. it's always there in the background. I like this chart a lot, actually, because I think people feel that inflation hasn't been that high over the last 10 years. But what this is really showing you is that if you had put £25,000 in the bank or under the mattress back in December 2009, what you could buy with that £25,000 has, by the end of last year, fallen. It's now £19,910. That's the sort of the real value. What your spending power of that 25,000 has fallen by that much. So even though you may see that the cash in the bank has increased in that period, the actual spending power has fallen. So if we sort of, I guess, flip it and say, guess what £2 million would be worth at your retirement, depending on different inflation rates. So you retire in 45 years' time. You've got £2 million today. What is the spending power of that £2 million going to be in 45 years' time? And if we assume inflation is at 2%, which is the government's target, then it reduces it to £800,000. But if inflation were to go a little bit higher than the 2%, so let's assume inflation gets to 5%, it pulls it all the way down to 200,000. And if we assume inflation is at 15% like the 1970s, it takes it all the way down to a little over £1,000. Now, it's probably highly unlikely inflation will run at 15% for the next 45 years. But if we think inflation could be around the government's target, you know, the £2 million going down to 800,000, or even if it runs slightly higher than the 2%, somewhere between the 2 and the 5, the spending power of your money has fallen significantly over that time period. And I think it's worth probably saying as well that this isn't necessarily just the saving for retirement. When you hit retirement, 65 years old, if everything's still left in cash and you assume you may live for the next 30 years, again, that money, the capital value, the spending power of that money is being eroded over time. So the second option was to put it on a bank deposit. So we put £2 million on bank deposit. We get interest at the bank of 1%, which is probably quite generous at the moment. In this case, they've assumed tax at 40%, but this just gives you an illustration. And then we assume inflation is running at government target of 2%. And you can see that you're actually going backwards. It's again all down to inflation. So the third option is that we invest it. And before I go into this, I just want to make it completely clear that we would never suggest to everybody that you invest everything. There is always cash to be kept for a rainy day, for emergencies. You always need something there in your bank account, just in case, just in case you need some repairs on your car or the boiler blows up. You need some cash there for a rainy day. But once you know that you've got enough for that rainy day, and the rest of it you are sort of saving for long-term savings for retirement or whatever it may be, then let's see what happens if you were to invest it. So equities have given a historical return since 1899 of 5%. So if you're looking for £2 million at retirement, what might you need today if you invest it into equities? And the answer is about 200,000. Those that were watching the inflation slides may have sort of already guessed that was going to be the answer. So that should make everybody feel a little less gloomy, but, well, how? How is that possible? So here's a quote from Einstein: "The most powerful force in the universe is compound interest." It's the power of compounding. And again, just another illustration, keeping the numbers really simple. We have £100 and we're going to get a 10% growth, just an example. And it's just this idea of constantly reinvesting the income that you're getting. And if you invest £100 today for the next 100 years, I'm not entirely sure anyone has got that long to wait, but it just shows you that £100 at 10% growth rate over 100 years, you'd have about £1.3 million. The reinvestment is important. Another example, and this is from Barclays, and they've been following this for over 100 years. So you have uber conservative great aunt Agatha, and she leaves you £100 and puts it in the bank. And what's it going to be worth today? And then you have racy Uncle Pete, who leaves you £100 and he puts it into UK equities. What would it be worth today and after inflation? So they assume that income is reinvested gross, and then you have quite staggering returns. You know, you've made more, and you've got the compounding returns from cash, which gets you to nearly £21,000. But you can see that return from equities gets you to 3.2 million. And this is where it's sort of slightly off to the right that I can't see it completely, but it's about £200 after inflation for the cash, and 35,000 for the equities. And this is why this graph shows it probably a lot clearer. So you've got your principal amount in the red. The blue gives you the interest, but you shows what happens if you get the interest each time, but you don't reinvest that interest. And then that sort of turquoisey colour gives you what happens. And it's this over time. It's the fact that you start to get this sort of exponential growth, the compounding nature of those returns over time. So in summary on this section, financing your life, it can be daunting, and I think there's probably a reason we don't all sit down when we finish university to work it out, and we just plod along. Investment markets can help you achieve your goals. Be aware of inflation. It's, as I said, it's always there, and it is just something to be aware of. And then, the secret is this idea of compounding, and it is powerful, and it's significant, especially if you have the ability to let the dividends and the interest be reinvested. I'm just going to hand over to Susie, who I hope is still there.
Hello, yep, I'm still here. Hello, everybody. I'm going to talk about investment risk versus reward. Kate's doing the slides, so I might have to occasionally ask her to keep moving them on. So the next few slides are on risk and reward. For every investment decision, the most important thing to do is to weigh up the balance between risk and return. So are you a risk taker in your daily life? Do you do extreme sports? Are you a financial risk taker? Do you like to go down to the betting shop or have a run on the Grand National each year? Next slide, please, Kate. So this is toss a coin and will you play? So what do we do when we look at investments? What we aren't doing is, sorry, Kate, can we go back a couple of slides? It's moving too quickly. Yeah, let's start with that one. Brilliant.
Do you want the next slide,
No, let's carry on with this one. This is brilliant. Thank you.
Okay. It does go through automatically.
Oh, is that why? Oh, okay. Thank you. So where do we start when we're considering an investment? An investor's utopia would be to take no risk and to receive massive financial returns. But unfortunately, we know that this just isn't the reality. One of the things we look at is what are the least riskiest investments. And if we take cash, for example, we will look at cash as being a safe investment because it doesn't fluctuate much in value. And as Kate mentioned, we can't look at cash as no risk because cash has the added risk of inflation, so your purchasing power can reduce over time. But with cash, it is safe and the value doesn't fluctuate as much, but because of that, you get little return for holding it. And especially with interest rates as low as they are at the moment, there are better things to put your money in. So in reality, the best that we can hope for is that we can maximize financial return and minimize our risk. So what do we mean by reward? There are two types of returns. There is income and there's capital growth. And when we talk about income, that comes in lots of different forms. So with cash, we all know that we get interest on our cash. Gilts and corporate bonds, gilts are government bonds. You receive a coupon as a reward for holding them. With property, we all know if you have a second home or you invest in property or commercial properties, you're going to get a rent as a reward for holding that. And when it comes to equities, equities are your stocks and shares. That is holding a piece of a company, buying into a company. As a reward for that, the company, when the company does well and has some money, they will pay you a reward, and that is as a dividend. The other side of your returns is your capital growth. And when you look at cash and bonds, they are counted as a sort of lower risk investment because you will get the interest and it's guaranteed, but you do not have the chance of that initial amount that you put into that investment growing much. Whereas as you go along to property, we know that if the value of your property goes up, you will make money on it, and that is the capital growth. And it's the same with equities. Shares can go up and down in value, and the capital growth is what you have made from the purchase price to when you sell it. And you might have heard the word yield being mentioned. Your yield is the dividends that you receive divided by what the investment is worth. And when we look at a portfolio, we will look at a client's needs. So if a client requires more income, we will buy more income yielding holdings within the portfolio. If they don't need an income, because say they're still working and that's covering their costs, we will look at holding stocks that have a better chance of providing a higher level of growth. And we could also be doing this for tax reasons. And when we add income and capital growth together, that is what we refer to as a total return. So the next slide is for investments as in life. The more risk taken, the greater reward you expect to receive. So if you have low risk, so for example, I mentioned cash and we've got gold here as an example, and something that doesn't fluctuate much in value, you would expect to get a low return for it. Whereas for something that is more risky and goes up and down in value and actually also maybe potentially has the ability to go bust, which we hope it wouldn't, but there's all the possibility, then you would expect a higher reward for holding a higher risk investment. And we've got Apple here as an example. You know, Apple at the time was a young growth company that got going, and we can see if you held Apple, which would have seen as a risky investment, you will have received considerable rewards over time. So the fundamental rule for all investment decisions is, are the level of reward I'm getting sensible for the level of risks I'm taking? And it is a balancing act between the two. So look at the expected returns.
So now we're going to have a look at a few asset classes. We haven't sort of put everything or kept everything in, but we just wanted to try and bring it to life with a few examples for you. Now you may think, oh, what's an asset class? An asset class is a group of similar investments that will have a similar structure and they're going to behave in a similar way. Lots of similar in there. But yeah, so here is sort of a sort of broad example of those for you. And you may automatically look at that and think, oh, well, you know, I'm a farmer, I understand farmland, or, you know, I love art. That's something that I understand, and I'm potentially, you know, you already have a few investments. Residential property. I've put this in here because I would imagine most of you own a home, or you know, have a home with a mortgage, and so I'm sure everybody, even those that don't own a home, are well aware that house prices have increased substantially over the last 20 or so years, more so in London. Although potentially is that about to change given the changes that COVID has sort of brought about. So we're all probably well aware of that, residential property. Some people absolutely love residential property and they feel that it's something that they understand, so they will, as well as having their own home, may have you know, buy-to-let portfolio or a couple of buy-to-let properties. They like it because, you know, it's there, it's a tangible asset, you can go see it, touch it, you can do things, you know, renovate it, and you know, get the rental income, as Susie explained. You know, on the other side of that, there's the cost to think about in terms of the cost of buying the property. It is an illiquid asset, and should you know, have a buy-to-let property worth, for example, 400,000, and you need 100,000, well, you can't sort of sell a quarter of the house. So those are just some things that we think about in terms of the investment pros and cons. Wine, a passion investment. I think that has to be said. I think people only get involved with the sort of top end wines if it's something that they know about themselves, and you know, there's a cost to storing it, obviously. You know, and there was yeah, the rumor, wasn't there, with Chinese drinking top end red wine mixed with Coke. Yeah, each to their own, I suppose. Gold. Gold is a Marmite investment, I would say. People, clients that come along will tend to either love it or hate it. It is seen as a safe haven. So in times of market stress, it can be seen as an asset that will protect value when financial markets, when stock markets aren't potentially doing so well. Some people see it as inflation protection, and I think the point there is just to make that that's not always been the case. Why don't people like it? I always think people don't like it because it doesn't provide that ongoing income. So when Susie spoke about the types of return that we get, most asset classes will provide some sort of income as well as the potential for capital growth. Gold does not do that. Gold is worth what someone is willing to pay for it, essentially. So any return you're hoping for from gold is in the capital, the price appreciation over time. That being said, with interest rates, or you know, we have potentially there's negative interest rates around the world at the moment. In a negative interest rate environment, the sort of argument against holding it because it doesn't provide an income doesn't necessarily hold much weight. You also have to think about the fact that, you know, central banks around the world have printed a substantial amount of money, and that it can be seen as a very good thing for gold.
So if we look at equities, which are your stocks and shares, this is owning a share in a public company. So that is a company that's listed on one of the major stock exchanges, and they've got examples here as Glaxo, Shell, Vodafone, Prudential, you know, could be Tesco's or any other share. Sorry, Kate, next slide. So equities are seen as higher risk investments, and for holding them, you do expect higher returns. We see them as higher risk investments because they are volatile. They do go up and down in value, and can react to many different things very quickly. But since the millennium, returns have been uninspiring, but over the long term, equities have produced excellent returns. And if you look at that graph, you can see how they have preferred compared to holding government bonds or cash. And one of the things with holding equities for a long time is, as you can see with the graph with the red line, is that even though we've had some major crashes during that time, if you'd stayed invested, you would still have considerably more money than where you started. So the longer you leave your money, the better chance you have making more money when you sell the investments. But do remember that all investments do go up and down in value over time. And so we've got some examples here of great investors. We've got Warren Buffett, and then great investments. I think the slide before,
Susie.
that's all right. The slide before had Apple, and if you were to have held Apple from the early days, you would be very wealthy now. So it just shows that holding equities can make you a lot of money if you hold it for the long term. And we're on to the next slide, which is asset quilt. So one of the most important things about holding equities is that you hold a basket of lots of different types of equities. So making sure that you hold UK equities, emerging market equities, US companies, UK government bonds, a bit of cash, gold, commodities, lots of different things, because as you look at this slide here, you will see that some react better and perform better in different years to others. So if we take gold for an example, which is orange, you will see in 2013 it didn't perform well at all, but then in 2018 it was one of the best performing assets. So if you have a spread of different assets in your portfolio, while one isn't performing very well, another one will be, and over time that smooths out your returns. So it's really important to diversify what you hold. So in conclusion, the greater risk that you, are you okay there?
Yeah,
in
no,
conclusion,
I was just literally going to say sorry.
The greater risk taken, the greater potential returns, but remember that the greater risk also has the greater potential losses. So the rule of thumb is always consider how much wealth that you are prepared to lose, and diversification is key. Make sure that you don't put all your eggs in one basket.
Absolutely. So again, it's that you keep enough in cash for emergencies, and so it's thinking about how much you are prepared to invest over a longer time period, and then also, as Susie said, yeah, don't put all your eggs in one basket. Diversification is key. I'm going to stop sharing this now, and then, oh, has that worked? And then hand over to Tony.
Thank you, Kate. I appreciate the presentation. I think it just goes to show we do have some challenges around technology with delays and everything else, but the points that you were making were very valid about long-term investments. So thank you for that. What I'd like to do is just take just 5 minutes or so just to give you an understanding of the plans that we do with our clients. A lot of financial planning goes involved in making sure that the money that clients have doesn't outlive them, and try and get them past the point where the funds are always there and available for them. With that, what we end up doing is using a tool, cash flow tool, which helps us plan the clients. So what I'd like to do is just share a screen with you, if I may, and I just need to just log into that again because I've been bounced out. Okay, so what I've done here from a this is a fictitious client, so I'm not sharing any information with anyone, but ultimately what we look to do here is just give an indication of how the software works at a high level, but also sort of put an indication about not putting off some retirement planning. So starting off on a timeline, and this is pretty much an outline of most clients. And when you look at this, so we've got things in here, you know, so buying a new car, we've got some big holidays planned. We've got Simon, the son, gets to the university. We need to build some costs for that. We've got a first car for Simon, and we've got potential some house deposits as well, some inheritance coming in. Then we've got some retirement dates, and then we've got some step down events and the dreaded mortality here. So all of this is predominantly linked to most clients that we deal with, and it becomes part of the plans that we put together. When we go back to the cash flow side of this, so what we look at on a year-by-year basis, we can see what's going on with the clients. So we're trying to look at these clients here. So we've got Stephen and Sue, both 25, and they've got a young son. So in this year here, Stephen's gonna actually start putting his retirement in place. So he's starting to put some income into a retirement plan. So he's got an investment attitude. So basically he's going to put into an unwrapped investment. He's starting to put 6,000 away annually. So £500 a month he's going to be putting away. The assumptions of net growth is 4%. So what we're trying to demonstrate here is if Stephen starts putting that away, and then if we move on to 5 years later, so Sue has delayed 5 years, so she's starting to put the same amount away 5 years later. As you can see here, the balance has already got to 39 for Stephen, so Sue's a little bit behind at that stage. But when we take into the effect of, as Kate and Susie mentioned earlier, about compound interest, we get to a point where the compound aspect of, we get to age 65, so we're looking at retirement. We can get down to these numbers here, and as you can see from Stephen, he's at 592 and Sue's at 459. So potentially there's something like about £130,000 of a difference just by delaying the investment starting 5 years later. And if we take out the cost of what Sue would have potentially put in there, or Stephen's what put in that 5 year period, which is about 30,000, so it's about 103,000 difference. So potentially there between the two top line figures, it's nearly 30% difference in a pot that eventually Sue and Stephen will be able to use. So again, this is very, very high level, but it's more of a case of us just showing how the software works to a point where this is what we're planning. So if we just go back here to mortality right the way through here, the plan itself, just on an annual basis, we can see the incomings, the outgoings, what we're going to do with from an investment strategy, what is needed for an income. So we've got at the bottom here, we've got all the expenses built in. So this pretty much is the go-to tool that we work alongside clients. And again, this changes on a year-by-year basis. We look at the changing circumstances and build that in, but it's something from a software aspect that we use that allows us to keep everyone's goals on track and at least making people aware. One of the things the software allows us to do also is to be able to compare. So if we've got various plans in place, as an example here, we've got the base plan retiring at 65, but if we were to say, okay, you wanted to retire a little bit early, what's the outcome? So we're starting to see red here. So we're starting to see that we need to do a bit more planning around that. But straight away, the colour schemes allow us to be able to talk through what we need to be doing from a client's perspective. I'll just drag in a few details here. So this starts telling me that the dark blue is income. We've got some extra income coming in, which was the inheritance, and then we're starting to use some savings and investments, and the brown colour is starting to use pension. So the software enables us to actually look at the most tax efficient way to actually make sure we've got the best use of clients' money. So again, this is all tailored and built for our clients' individual needs, but it is something that we use for all our clients. So I just wanted to give you a brief overview of that, but it's more of a case of using the software enables us to keep the focus in certain areas. And if we're getting to things like, do we not need to start planning for later life care? Do we need to start planning for inheritance tax planning and various things like that. We can do that on an ongoing basis. So I'm going to stop showing that at this moment in time. You know, from my perspective, it's all about these sort of webinars. It is talking to clients and getting them to understand what we do, what the investment managers do. And as I say, if there are any questions, please just drop us a note at the bottom. Alternatively, you know, if you want to drop us an email, then we will get back to you later on today if that's better. But I don't know if there's any questions at this point. So it doesn't look like there's any questions. So looking at that, Kate, I don't know if there's anything else that you would, Susie, would like to add at this point.
No, I don't think so. I always find it really fascinating seeing that software. I think it's amazing. Like, if I can ask a question, if that's allowed.
Yeah.
So does so any changes that are made government level, tax level, that's automatically then updated within the software, so that you can see how that's going to affect different clients?
Yes, so as
yeah,
things like today, if Fishy comes up with any new plans or tax implications, as soon as they come into force, then the software is updated at that point. So we can then make sure that we've always got the current legislations in place. So obviously then that affects the planning aspects. And if we have to change strategies going forward because of that, then we will do. Okay.
amazing.
Well, like I say, probably just
nothing further to add from us.
Okay, that's fine. I think with that, I think I'd just like to thank everyone for taking the time to join us today. Hopefully you found some information out of that may be in use in the future. I'd like to thank Kate and Susie for their participation, very much appreciated. And as I said, if you have any questions, please come to Beaufort Financial and I'm sure we will be able to give you some answers going forward. Thank you very much for your time, everyone.